Hello again. Thank you all so much for joining. It's great to see some familiar faces, some new faces as well for the third and final session of our financial wellness series with HYPE, Hub's Young Professional Group, and AIM's Young Professional Community. For the returners, welcome. Whether you've been to the first or second session, I appreciate your attendance and, of course, here as well. For the new folks, hi, it's great to see you. My name's Jesse Goldberg. I am the HYPE New England Region Director. In New England, and this is our third and final session on investing basics and long-term investing, following our budgeting and retirement sessions. So I really appreciate. Just want to say thank you to everyone for the consistent attendance throughout the series. I hope you've all found some educational value here and took something away from it. And stacking that paper, because that's what it's all about at the end of the day. So with that, thank you all again. I'll turn it over to the AIM folks, and we'll get ready to dive in here.
Thank you, Jesse. My name's Laura. I work at AIM on our membership team, and I also work with our young professionals community. So if you're joining us from AIM, thank you for coming. We're excited to have you here, and just want to say a big thank you again to Hub, Jesse, and Matt for partnering with us for this financial wellness series. So without further ado, I will pass it off to Matt.
Great. Thank you, Laura. Thank you, Jesse. Thanks to the HYPE in the AIM crew. This is awesome. Thrilled to be here again today. Again, my name is Matt Green. I am from Hub's Retirement and Wealth Management Group. Here today to discuss the basics of building a well-diversified portfolio and some principles of long-term investing. And while this is anecdotally for young professionals, I think this is really great for anyone wanting to learn more about ways to reach your long-term financial goals. Now, we've talked about budgeting about 4 weeks ago, ways of assessing your spending and tips to controlling expenses. We also had a retirement planning session 2 weeks ago that covered steps to replacing your income in retirement. And now that you've freed up some discretionary income through budgeting, started saving some of that towards retirement, now we need to know how to invest and how to invest prudently. So my goal here today is twofold: help you understand the basics to building a portfolio for a long-term strategy, such as your 401k, your 403b, or other retirement accounts. And number two, help you understand the keys to maintaining investment discipline, especially when volatility appears. Stocks go down, and we inevitably hear or think this time is different. I can promise you the markets will test you regularly. And I hope that some of what you learned today will help you invest with discipline like a pro. So we have a lot of material to cover, so I'll wait to the end to take questions. But please feel free to add any that you have to the Q&A. And with that, let's jump in. We are all here today because we know investing is important to reaching our financial goals. Investing is also a topic routinely referred to as confusing, intimidating, or overwhelming. The financial industry has built up its own language and admittedly completely made up terms of jargon and acronyms, and it can be really tough to decipher at times. The good news is it doesn't have to be so difficult or overwhelming, because you really don't need to know all of these terms on the screen here. We'll break down some of the key terms you may want to focus on, but first, let's address the question, what do we even invest in? And now we're going to really kind of brush this with a broad stroke here. We're going to start with something that we all have access to through our 401k, 403b, or other retirement plan accounts: mutual funds. Many of you have heard of the term before, but if not, all of the investments, for the most part, all of the investments through your 401ks are generally going to be mutual funds, not individual stocks like Apple or Microsoft, not individual bonds or CDs that you can get at a bank. There are many different types of mutual funds that cover pretty much every area of the investment landscape. But before we start talking about different types, let's briefly go into what a mutual fund is and how it works. A mutual fund pools money from many investors like you and me. And an investment manager that sits above that mutual fund uses the dollars that go into that fund, those investment dollars, to create a diversified portfolio by purchasing many, many different stocks, bonds, or other investments. So let's break this down a little bit. So let's say, for example, you want to invest $500. Where do you start? You can invest that in a number of different stocks or companies like Disney, Apple, Netflix, Microsoft, AT&T, Walmart. Pick a stock, pick a company on this screen here. The only problem is if you're picking one stock, you want that stock to be the right one. The one stock that's going to outperform all other options that you have. And that can be pretty tough to do. Many people dedicate their entire careers to accomplishing just that. Alternatively, you can invest in a mutual fund that aligns with your risk tolerance. And in this example, a mutual fund is nothing more than a collection of stocks that spreads your risk across a number of different companies. So when you put $500 in this hypothetical S&P 500 type mutual fund, which would consist of 500 different stocks, you've invested $1 across 500 different companies. Now, why is this so important? Well, we want to protect against any one company from derailing your retirement goals, whether that's from severe underperformance or maybe even bankruptcy or going out of business. And to put that into perspective, in 2001, a company called Enron, one of the largest companies in the US at the time, filed for bankruptcy. Many Enron employees had all of their retirement savings in their own company stock, the company that they worked for. Some of them had millions. Not only did those employees need to find another job, those employees lost everything invested in that one stock, and their retirement plans were subsequently very much delayed. So mutual funds have two key advantages: provide you with immediate and instant diversification, and they have a management team responsible for professionally managing the monies that you put into those funds. So now that we've covered the basics of what a mutual fund is, let's get into the basics of investing. Using mutual funds to help you build a well-diversified portfolio. There are really 3 steps, as you can see here, starting with asset allocation, diversification, and rebalancing. Okay, let's jump into asset allocation. This is the process of balancing risk and return across 3 major asset classes: cash, bonds, and stocks. Each one of them having their own risks and rewards. For example, cash can be viewed as a great asset class with a description of money market funds, CDs, or T-bills. This has low volatility. Investment risk or volatility is very, very low, and therefore the trade-off is an expected low potential return as well. And what cash really is, it's designed to maintain the value that you put in. So if I put $1 into a cash account, if I put $1 into a money market or a CD or a T-bill, I'm expecting to see that $1 tomorrow plus interest. That $1 2 days from now plus interest. I'm expecting to see that $1 regardless of what happens in the bond market or in the stock market, which we're going to get to in just a second. The risk of cash is inflation. Inflation is the cost of goods and services over time. Okay, inflation would be the relative percentage or increase of cost of goods and services from one year to the next. So let's just say there's a 5% inflation on a gallon of milk. Last year, a gallon of milk was $1. Next year, a gallon of milk is $1.05. The very next year, if it's 5%, again, it's going to be $1.10, so on and so forth. So we need to keep up with inflation. Inflation is going to be there regardless of what happens, and we need our investments to keep up with that. Cash doesn't do the job. Average return over the last 20 years was between 1.5 to 2.5%, and inflation is at 2.5%. So cash serves as a safe haven. It serves as your principal protection portion, and it certainly deserves a spot in a portfolio, most portfolios. However, the larger part of the portfolios for a long-term objective would be bonds and stocks. Now, these are some of the terms that are, I think, intentionally designed to confuse people. You very well may hear bonds or fixed income. They're the same, okay? A bond fund or a fixed income fund are the same thing. They are, they can be used interchangeably. And what a bond is, it's a loan to a company, okay? Bonds are loans that you make to a company over a preset period of time. In exchange, that company pays you interest. So let's say, for example, you want to loan $1,000 to Microsoft because they want to come out with a new Microsoft Surface, or they want to come out with a new widget. So you loan $1,000 to Microsoft for 5 years, and in exchange, Microsoft tells you they'll contractually obligated to pay you what they say is maybe 4%. Bonds are a safety part of your portfolio. They are designed to get you a return of somewhere between 4 to 5% on average. That means your investment risk and potential return is somewhat moderate, and you should outpace inflation by maybe 1 to 2% over time. And the last asset class, again, another interchangeable words here, stocks or equity. If you hear someone talks about a stock, or if you see someone or hear someone talk about an equity, or if you see something on some of the slides that you'll see in a little bit, stocks and equities are the same, bonds and fixed income are the same as well. But stocks are different than bonds, and bonds are different than cash. Stocks, you're an owner in that company. Okay, there are no preset returns. There's no preset periods of time. You become an owner in that company. In exchange for that ownership, there's a fluctuation in value. You share in the future profits of the company, or you share in the fall of the company. Your potential return is unlimited. Yet, like in the case of Enron, there's no guarantee of future performance or success. So your investment risk and potential return is high. Your inflation risk is low because over time, if you're in a diversified portfolio of stocks over time, at least over the last 20 years, you would have seen on average a 9 to 10% rate of return, certainly well more than outpacing that of inflation. So now that we've gotten to know the major asset classes, we need to determine the appropriate blend or the appropriate amount in stocks, bonds, and cash. And anyone on this call likely fits somewhere on this spectrum here. From the very left, a conservative portfolio. And the light blue is going to be stocks, the darker blue is bonds, and the green is cash. So someone perhaps maybe closer to retirement, or perhaps may not be able to withstand the volatility within the markets, maybe has a 20% stock portfolio, 75% in bonds, and a 5% cash position. In this case, we use the terminology of a 20% or 20-80 portfolio, 20% in stocks, 80% in bonds and cash. Now, while this portfolio decreases on this spectrum, this risk spectrum, decreases the investment risk, if we're looking at or thinking about the prior chart, what that means is we have a slightly higher inflation risk. Our return is likely going to be lower, and therefore the cost of goods and services will eat into the overall return of that portfolio. Vice versa, on the other side, aggressive growth, 95% in stocks and 5% in cash. We should be buckled up. We should be prepared for an increase in investment risk, volatility from day to day, week to week, month to month. But in exchange of that increase in investment risk, we should see a decrease from an inflation risk perspective. We should, over time, so long as we stay disciplined, so long as we adhere to some of the things we'll learn today, you will outperform inflation by a large margin. But we all fit somewhere on the spectrum. Don't have to be on the right, don't have to be on the left. Maybe we're somewhere in the middle. A balanced portfolio, while one would argue a balanced portfolio might mean 50% in stocks and 50% in bonds. In our industry, really, it's more a 60% stock to 40% bond portfolio. Just something else our industry has decided to do to make things a little bit more confusing for everybody. So now that we've decided how much in stocks versus bonds we're comfortable with, I should say, actually, we are going to send something out. We're going to send out a questionnaire afterwards to everybody that will help you narrow down the appropriate amount of stocks and bonds that you may want to consider for your own portfolio. Now, that's really step one. All right, now once we've decided how much in stocks and how much in bonds, we need to diversify across the various sub-asset classes. And I'm just going to give you an example here. But within stocks, we have large US stocks. We have medium US stocks in terms of size, small US companies. We have international. We have emerging markets on the fixed income side. We have short-term, medium-term, long-term. We have corporate bonds. We have treasury bonds or government bonds. All of these asset classes that you don't necessarily need to all know right now. But what I want to do is give you an example of how diversification works and the core asset classes, starting with the United States, companies in the US. And what this tic-tac-toe box here is, this is called the Morningstar Style Box. Okay, this Morningstar Style Box segments the types of asset classes or the types of mutual funds by asset class. And the first way we think about it is, well, how big are they? And we call that market capitalization. So the larger companies north of $10 billion in market capitalization are in this top row here. Medium-sized companies between $2 and $10 billion reside in this middle row here. And then small US publicly traded companies are in this bottom row here, under $2 billion of market capitalization. Now, the next is investment style. So we look down these columns here. Value companies are generally going to be insurance companies, financial companies, utility or energy companies, or companies that have been around a rather long time. I'm going to get into an example of how some of these work. But on the far right-hand side, completely different type of investment approach with the growth side of things. These are, generally speaking, going to be pharmaceutical or technology companies. And then right down the middle here, we have a blend of value and of growth. Now, we have 9 tiles here. We have 9 squares. We have also, if we liken it to a baseball field, we have 9 positions. And what we typically think is, you're going to want to have a percentage or a part of your allocation or part of your portfolio in each one of these. So I want to try and bring this to real life a little bit more here. This is the same style box that very well may represent some of the company or some of the mutual funds that you have in your own 401k or 403b plan. Okay, the investment style along the top, company size or the market capitalization, large companies, medium, and small on the bottom, value, blend, and growth. Okay, so in this case, let's just say you did have JP Morgan Equity Income in your own 401k as an available investment option. What that means is that your 401k plan trustees, those making decisions on what funds to offer you as a plan participant, they've hired JP Morgan to manage this large cap value fund. Now, what does that mean? That doesn't really mean too much unless you lift up the hood. And when you do lift up the hood, you'll actually see how this portfolio, how this mutual fund is invested. And I know we're talking big numbers here, but let's just pretend we have $100,000 in this fund. It'd be spread out amongst 185,000 or 185 different stocks. So if we had $100,000 of this fund, we would actually at this time own about $4,500 or $4,540 or 4.54% of J&J. We'd own 3,220 or 3.22% of Procter and Gamble, 3.08% of JP Morgan, Verizon, Comcast, Intel, Cisco, Pfizer. You get the point, right? So these are the types of companies that you would expect to see if you lift up the hood of mutual funds on the large cap value side of things. Very different type of investment approach relative to ClearBridge managing a large cap growth mutual fund. There's 121, again, this is dated, this is just for illustrative purposes, but 121 different companies. Certainly not all invested in just Amazon, just Facebook, just Microsoft or Alibaba or Google or Apple, so on and so forth. So this is, kind of giving you a lens into what mutual funds actually are. Here are some funds that you actually may see in your own 401k plan that you may have some available investment options for. And then right down the middle, you'll see the S&P 500, in this case, Fidelity 500. Now, let me just take a second just to describe what the S&P 500 is, because we're going to be using that as a common benchmark as we talk about the markets and we talk about investments. The S&P 500 is, generally speaking, the barometer of the US economy. Okay, it's the top 500 companies in the United States by market capitalization. Okay, so as Apple's the biggest company in the world, if you had $100,000 invested in the S&P 500, you'd have slightly higher relative weighting towards Apple. If Microsoft is the second biggest company in the United States, you'd have slightly less, but more than the third biggest company in the US. So the S&P 500, again, going to be a real important part of what we're talking about today. But moving on to the last piece of the investment basics, once we've determined how much in stocks and bonds we want to have in our portfolio, we've then determined how much we want to have in large cap value, large cap growth, small cap value, small cap growth, so on and so forth. We need to regularly review our accounts, let's say maybe 3 to 4 times a year. We want to make sure your choices and allocations are still consistent with your goals and your risk. We also want to rebalance or redistribute money among investments to make sure your original allocation is maintained and stays intact. Okay, so let's just say my initial portfolio, let's say blue is stocks, yellow is bonds, and green is cash. In this case, we have a 50-50 portfolio, 50% stocks, 50% bonds and cash. And the stock market has done really, really well. So my portfolio has grown, as you can see by the size of this pie chart. The portfolio has grown, but it's really grown by way of the stock market, the stocks in my portfolio increasing in value. And what that does is it now just means I have, one, a larger portfolio, but two, I have an outsized portion of equity or stocks relative to what my initial risk tolerance indicated. So the process of rebalancing a portfolio is always selling something that's grown, bringing us back to that initial allocation of a 50% stocks and 50% bonds. The overall pie chart grows, but we always want to make sure that our allocation is consistent over time with what we initially set out from an expectation perspective. So choosing your asset allocation, how much in stocks and bonds, choosing how to diversify within the sub-asset classes, and portfolio rebalancing. This may sound like something, not everybody's ready to just jump right into right now, and that's okay. You don't have to do this on your own. Okay, you can either ask an advisor to help build a portfolio consistent with your risk tolerance and long-term goals, or you can use some investments that you likely have in your own 401k or 403b plan called target date funds, we say do it for me type of approach. Okay, as soon as you use a target date fund, you're invested where all of these X's are. Okay, just depending on how close or how far you are from retirement. But if you use a target date fund that you may have in your 401k or in your other retirement accounts, as soon as you put $1 into those funds, they're invested according to the proximity that you choose from retirement. Now, I'm going to walk through this a little bit here, just to give you an idea of the importance and the power of target date funds. So each one of you don't have to do this necessarily on your own. But target date funds, they usually go in 5-year increments. So if I'm going to turn 65 around the year 2050, I would first start by looking at the target date fund that has 2050 in the name of that fund. And this, for me, would represent my retirement date, this perpendicular line right here with a 0. Now, the farther I am from retirement, the more years I am from retirement, you can see I have more in equity or more in stock, as defined by this axis here. So I'm aggressive. I'm really aggressive. I have maybe 100% or close to in stocks as I'm younger. And as I get to 20 years before retirement, this target date fund, the managers of this investment automatically start selling stocks. They automatically start buying more bonds. So I have a glide path. I have a rather I have a much lower percentage of risk, a much lower percentage of stocks by the time I get to the year 2050. And a 50% stock, 50% bond portfolio at retirement is a heck of a lot more appropriate for most people than if I were to stay in a 100% stock portfolio, never change, and then all of a sudden realize, hey, the market went down in 2050. I don't know what to do. I would have been much better off if I had this type of portfolio. So again, target date funds, they should be in almost every single one of your retirement plans you have through your company. If you have any questions, I'm more than happy to help explain those to you. So those are the basics to building your own diversified portfolio or using a target date fund to do that for you. Now we're going to pivot into the principles for long-term investing with these 3 key steps. Fair warning, there are a lot of charts, a lot of graphs. I'll do my best to walk through each one of them slowly. I'm a little behind because of the Zoom glitch there, but I think we'll be able to make up a little bit of time. But number 1, stock markets go up over time. Not every year, not every quarter, not every month or week, but over time they do. Timing the market is tough. You could argue it's almost impossible. We're going to talk about the impacts of that, how tough it is, and if you don't time it, the impacts of it. And diversification works. It may be boring at times. It may feel like we're not going up as much as the market. It may feel like when the market's down, we still go down, but diversification works. It works over time, and we'll take a look at that as well. The first thing I think everybody should hopefully walk away from with this is over time, the markets will go up. And we're talking again about the S&P 500. We're talking about the overall US economy, the stocks or the companies that make up that S&P 500. On average, those companies are going to go up over time. They have to, right? This chart dates back to 1890, way in this far left. Right, it was flat for the first several years, first 30 years or so. Then the Roaring 20s, the Great Depression in the 1930s, with a rebound and flat. But if we were just to zoom out, right? If we were to zoom out, we see a level here in the far left, and we see something in the very, very top right, meaning over that period of time, the market just went up. If we just stayed disciplined, there would have been a lot of periods of concern, a lot of jagged edges as we zoom in. However, if we're building a strategy for a long period of time, we're not investing for these very, very short periods of time right here. The way I typically describe it is the premium we have to pay in order to participate in market growth over time are these jagged edges, these drops in the market, or more importantly, these gray periods here, which are defined as recessions. We are going to come across them. We're going to come across many of them as young professionals in our careers, in our investing career or our working career. However, we've come through them. We'll come through them again. And if we can come out of 2008 and 2009, the global financial crisis, if we can come out of 2020 when COVID hit, then we can come out of anything. One thing that I can almost promise you that you'll hear inevitably is this is different this time. The reason for the volatility is different. It's not the same. This one's worse. This one's going to be bad. This one we're not going to come out of. The reason for the recession very well may be different. The reason for the volatility may be different. But volatility itself will remain. It will just be a different reason for it. The next thing I'd really like for you to know in terms of the market goes up over time, but volatility is normal. This is incredibly busy. It's a really busy slide. I'm going to do my best to walk through this slowly. And hopefully we won't have any repeat events from those periods of time in this last slide here, like, the tech boom bursting, global financial crisis, stagflation, wars. But we're going to have different events. We're going to have other reasons that are causing concern. We're going to have other reasons that the market goes down. That won't change. And while this visual is awfully busy, I think it's incredibly powerful for you to realize that volatility is quite normal. These red dots dating back to 1980, these represent the intra-year decline in the S&P 500 from its highest point that year to its lowest point that year. Okay, so let's just take, for example, 1997 or 8. At one point in the market, the S&P 500 went down 19%, almost a technical correction in the market, or I'm sorry, almost technically a bear market. But the S&P 500 that year ended up 27%, as you can see by this. Okay, so the red dots are the intra-year declines. And as we can see, dating back to 1980, there is a red dot in every year, meaning at some point the market corrects. The market comes down. It's just how much. Well, that how much is on average from 1980. There was an intra-year drop on average of 14.1%. Okay, so at some point, we should expect the market year to year to come down almost 15%, and that would be normal. That would be a normal year on average. Now, if we look at these solid bars, this is where the S&P 500 ended the year. And 34 out of the 45 years, we see positive returns. Okay, 34 out of 45 years, or 75% of the time, the market ended positive. So let's say it differently. On average, we should expect a decline of anywhere between 10 and 20% from year to year. However, regardless of that decline, we should expect to see positive returns 75% of the time in our portfolio. The hard part is when people get emotional and want to sell out of the down markets, you don't have to be right once. When you got out, you have to be right twice. When do you get back in? Otherwise, inflation is just going to cripple our returns. And that's so hard. The few people that get lucky enough to time the market right when they get out, when they get right back in, they write best-selling books about it. But those who don't get it right realize this type of experience here. Timing the market is so hard. Okay, now let's just say we stayed invested. We invested $10,000 back in January 3rd of 2005. ending December 31st of 2004, our $10,000, if we stayed fully invested, we just put our head in the sand, we just stayed disciplined, our $10,000 would have grown an annualized average return of 10.4%, or differently said, our $10,000 would have turned into almost $75,000. Now, if we missed only 10 days in that period of time, in that 20-year period of time, our return almost gets cut in half. If we missed only 10 days, our return goes down to 6.1% average annual return. If we missed, on average, the best day every year, missed 20 of the best days, our return gets cut to 3.5. And if we miss any more than that, then we're pretty much having a negative return. So it's just goes to the I think the thesis, or the fact more so than anything else, that volatility is going to be there. The markets have to go up over time. We're going to continue to innovate. We're going to continue solving for problems in this country and around the world. We're just not going to get good returns if we try selling at the bad times and buying back in at the good times. As a layperson definition of volatility, I could use maybe the good days are closely followed by the bad days, or rather, maybe said differently, the bad days closely follow the good days as well. Okay, so if we just focus on this box here, 7 of the 10 best days occurred within 2 weeks of the 10 worst days. That's awfully confusing. I think I like my definition better. The good days closely follow the bad days. Let's put that theory to test. This is the recent market return from the tariff discussion that we saw starting in March, but came out on April 2nd. So from the highest point in the market on February 19th. Now the highest point in the S&P 500 was February 19th of 2025. And in the matter of about 3 weeks, the S&P 500 went down almost 20%. It went down 18.9%. Now, what I can say is there was a tremendous amount of capitulation. There was a tremendous amount of fear. There was a tremendous amount of concern about what was going to happen next. We're already down 20%. What do? We have to get out of the market, right? And the answer is no, right? I had probably most of my phone calls. They're the time where I had so many phone calls, so many concerns. If I could overlay the amount of concerns that people have with perhaps the amount of opportunity that exists in the market, I think it would be a 1-to-1. And this goes to show from that point, April 8th, when there's so much concern and fear, if we look at from April 8th all the way up until the end of day yesterday, we're up 21% in the matter of not even, or a little bit over 2 months. So we're never going to be able to guess this period of time to buy, but we're certainly not serving ourselves well if we use these periods of time to sell. So the good days closely follow the bad days. This is really good proof of that. Some of the worst days right here, followed by some of the best over the next 2 months. Now, the average investor over the last 20 years, according to JP Morgan, has a 3.6% rate of return. If you recall what we were talking about last time, for those of us that joined, we were looking at maybe a 6 to 7% rate of return, which I think is conservative for retirement plan purposes. That's a pretty conservative assumption, so long as you don't make investment mistakes and you turn into that average investor. Now, if you were just in the S&P 500 over that same 20-year period of time, you would have had a 9.5% rate of return, but it's unlikely that really anybody's invested strictly in the S&P 500. More realistically, over a period of time, you may be invested in 60% stocks and 40% bonds. This is a well-balanced portfolio that sure absorbs some volatility when the market is bad, but really does a good job balancing risk and return. And if you had that type of portfolio over that period of time, you would have had a 7.4% rate of return. That certainly helps you get to retirement. If we're planning on 6% in our analysis and our forecast, and you get 7.4%, well, that means you either get to retire earlier, you have to save less money, or you get to spend more money in retirement because your balances are that much greater. Now, something that I hear quite often is, well, the market was up, I wasn't up as much. The market was down, I was still down. Diversification will work over time, but it just doesn't always feel great from year to year. So let's just take a look as we compare S&P 500 versus a diversified portfolio of 50% in stocks. 60% in stocks and 40% in bonds, 40% US stocks, 10% international stocks, 5% small cap, and 5% emerging market stocks, and 30% US bonds, 10% high yield bonds. All right, so from 2000 to 2022, the S&P 500 was down 40%. Now, a diversified portfolio, you were still down 17.3. It wasn't even close to 40, but you're still down. Kind of the psychology says, well, I still lost money. That doesn't feel great. 2003 to 2007, the S&P 500 was up 82%. I wasn't up quite as much. I think this is probably a pretty bad example. Psychologically, I wasn't up as much. You're pretty close. The other examples, I think, are a little bit better. 2008, S&P 500 was down 37%. A diversified portfolio was down 24.5%. You still lost money. 2009 to 2019, S&P 500 was up 351%. My diversified portfolio was up an abysmal 195. I didn't make nearly as much, but I was still up. 2020, different periods of time through COVID. The S&P 500 was down 30%. I was down 20 in this example. And then as we rebound from COVID, as vaccination came to market, the market went on a tear. That market was up 70%, but I was only up 42. I didn't make nearly as much. But if we look at the total return from those periods of time in the S&P 500, total return was 268% versus a diversified portfolio that was up 275%. My $100,000 grew more by being in a diversified portfolio because I didn't go down as much during those really tough, really challenging periods of time. Therefore, I didn't need to go up as much like in 2009 to 2019. I didn't need to go up nearly as much as the S&P 500 because I wasn't down as much in 2008. I wasn't down as much in 2000 and 2002. So diversification may feel boring. It may feel like it doesn't always work, but it does work even when it feels like we're losing or we're not gaining nearly as much. So in summary, I hope you take away from today, over time, the market goes up. The history tells us that there's very companies, as I mentioned, are going to continue to innovate. They're going to continue solving problems. They're going to continue to find ways of making money. The market overall will go up. It has to. It just won't go up week to week, month to month, quarter to quarter, year to year. Volatility is normal. Volatility can be our friend. We can use volatility to our advantage. We just need to be disciplined. Don't time the market. It's dangerous. It's hard to do. You have to be right twice. You have to be right when you get out. You have to be right when you get back in. And number 3, diversification does work. Stay diversified. Stay disciplined. It has been proven that those that create a plan and meet regularly to monitor and update their plan have a much higher likelihood of accomplishing the core principles to long-term investing and therefore they're much more likely to bring their financial lives to fruition. And I think in closing, I don't think anybody except for Warren Buffett says it best, is we don't have to be smarter than the rest. We have to be more disciplined than the rest. And I completely agree with that. You will be tested. You will be tested through the challenging times like April of this past year, like in 2022 when the market went down 22%, like in 2020 when COVID happened and the market went down 34%. But we look at that. If we zoom out, we'll realize that the market over time is quite favorable, and we just need to stay disciplined. So with that, I am going to pause here and take any questions that the group may have.
All right. Great stuff. Thank you very much, Matt.
Of course. I see. Can't see this.
I think we got one question in here from Cynthia Squires. Suggestions for retirement within 5 years.
So suggestions for retirements within 5 years, everybody's going to be a little bit different. It depends on many, many, many different things. But what I would say is this is the perfect time for somebody approaching 5, 7, 10 years of retirement is to do a really thorough analysis of what you need your money to do. What should your allocation be based on what you need your balances to do? What are your expenses? What are your expected incomes? Okay, if your expenses are $6,000 a month and your income from Social Security will be $3,000 a month, well, you need your portfolio to make up a $3,000 difference. Is your portfolio invested appropriately to be able to deliver that type of income to supplement your retirement lifestyle? So I can't necessarily paint that with a broad brush. However, I would say there's certainly a blueprint. There are steps to take to no doubt understand what the portfolio should look like for somebody retiring in 5 years for your particular circumstances.
Great. All right.
Of course. Would you recommend employees split 401k between Roth and traditional? This also, I think, depends a lot on where you are age-wise, where you expect tax rates to go. I happen to love having a blend of pre-tax and Roth, Kevin. I think it makes perfect sense. Knowing you, my good friend, I would say yes, I love that idea. However, I would love to maybe chat and say, well, what would be the perfect split be? Is it perfectly half? Is it maybe 80-20 pre-tax to Roth? Is it maybe 40-60, so on and so forth? We could have that conversation, but I think with a broad brush on that one, for folks that have 20 or more years to retirement, I think Roth and pre-tax split makes really, really good sense. And great question. Thank you. When should you hire a financial advisor? How do you ensure that they are working in your best interest? Well, they have to be a fiduciary. You have to make sure, one, they are not a broker, they are a fiduciary. Fiduciaries by law have to act in your best interest. And when they are recommending something, they're not recommending something that's just suitable for you. That's okay, right? Suitable would be appropriate for you based on, what they know about you. Fiduciaries have to be acting in your best interest and providing the very best solutions for you based on your goals, your objectives, risk tolerance, time horizon, so on and so forth. When should you hire a financial advisor? Is I think when you feel like you're maybe a little over your skis, you have more complicated questions than you feel as though you have the answers to, whether that's planning for retirement, maybe that's planning for saving for kids' education. Maybe that's estate planning questions, tax planning questions. I think if you're asking a lot of questions that you don't know the answers to, then maybe it makes sense to at least consult with a financial advisor that would be able to help you with those certain areas. If you have an opinion, what are your thoughts on incorporating Bitcoin into? I knew this question was gonna come up, and I'm glad it did. So this depends on your risk tolerance. Okay, this is your risk tolerance. What I will say, is just like the Enron example. What I think you should do is have, in just a general investment theme and thesis, is you should have no more than 5% of your overall portfolio in any one position, stock or Bitcoin. Okay, so that's, I think, the fundamental rule of thumb. I happen to, as a long-term investor, like having Bitcoin as a part of the portfolio, relatively small portion of the portfolio. I am okay. I am okay if that Bitcoin goes to zero. My life will not change. If it happens to go through the roof, great. It also probably won't change that much because it's not a huge part of my portfolio, right? So I think that's the theory, is you invest with something like Bitcoin that is completely speculative, that will go down at any point in time 30 to 70%, and you have to be prepared. If that's you, you have to be prepared for that type of movement. You have to be prepared to hold it so you can rally when markets like this, when Bitcoin does come back over the last 8 to 12 months. So I hope that answers your question. Happy to have a more of a one-off conversation with you, Cole, on that, but I think you asked a great question that a lot of people are probably wondering. Any insight into platform like Robinhood, Fidelity, Wells Fargo, etc., in terms of comfortability for someone just starting their investing journey? I love it. I worked at Fidelity. You're welcome, Cole. I worked at Fidelity for 5 years. I love Fidelity. I think they're awesome. I have never used Robinhood because I have Fidelity. I've never used Wells Fargo because I have Fidelity. However, regardless of what platform, I think it's awesome to start your investing journey with one of these. And what I do think makes sense is just to really, really know what you're getting into before you invest. Know what you own. And if you don't know what you own, simply use a mutual fund to give you exposure to that. Okay, and I'm not telling anybody to go invest in the S&P 500. I'll just use, again, Warren Buffett's rule of thumb is before you invest in any one stock, you should have $5,000 in the S&P 500. Okay, and I think that makes pretty good sense before you start investing in individual stocks. If you're investing in individual stocks, you should know when their quarterly calls are. You should know when their quarterly report earnings are. You should know a lot about the management team. You should really know about the company. You shouldn't just be investing in a stock because someone at the barbershop mentioned it to you. So I hope that helps answer that question, Jesse. I'm not sure if it does, but all of these I feel as though are great platforms, all of which I would be certainly comfortable with having my own money invested there. And they all have, in general, the same, access. They have the same fee structure being very low, right? It's very, very hard to be transactional right now. Robinhood, Fidelity, Wells Fargo, they're really designed to get people in and then have people branch out into their other services from there. Do you think that an IUL is good for investing? And if so, what would you look out for when deciding to go this way? So this depends on your particular circumstances. I tend to like to keep insurance as insurance and investments as investments. I could be, certainly there are cases to have an IUL serve as both. IUL, for anybody that may not know, is an index universal life. It blends an investment, somewhat of an investment component with a permanent life insurance policy component. There are absolutely cases in which those make sense. If I was thinking about it from a young professional perspective, which I'm going to lean on right now, I don't necessarily think that would be maybe the first place I would go. I think if you need insurance, you buy a low-cost term policy to cover you and your family for what you need, and then you invest the remainder. But Alexis, I would be really thrilled to have a conversation with you, understand your goals, objectives, and if that would be something that would work for you. And then Cole, thoughts on real estate investments? I think I don't do annuities make sense? So let me touch on that in a second. Thoughts on real estate investments? This is very, very hard to necessarily paint with a broad brush because we could either be talking about real estate as through a real estate investment trust that you may have access to through your 401k. I think having a little bit of an exposure there makes sense, not too much, maybe anywhere between 3 to 5%. Or, are we talking about actually having hard real estate? That would be something that would be a little bit more personal, from a, personal financial conversation. But in general, if we're talking about having an allocation in our overall investment portfolio to real estate, yes, I think that does make really good sense for diversification and risk return profile. And then, do annuities make sense? This is another very personal question. Annuities can be really, really helpful and beneficial if they solve a very, very specific goal and a very specific need. If they do not, then they can oftentimes have high fees, high expenses, low benefits. So I think it depends on what's the need for the annuity, what is the annuity in particular providing in terms of its benefits. Again, all of the things that I would be happy to analyze with you. I've been hearing about investing in gold. What are your thoughts on this? We're always going to hear about something that's gone up really, really high in a very short period of time. So gold has just been on a record run. If you're invested in a diversified portfolio, you very likely have an exposure to gold. And that's where I think investing in gold, it makes sense, is having an exposure, albeit relatively small, because during really, really challenging times, gold is going to help provide a safe haven. It's going to provide, very uncorrelated return to markets when they're down. Typically, gold will go up. However, if we do think about, well, how often do markets go up? Markets go up 75% of the time, as we talked about in that really busy chart that had the red dots and the solid bars. So not to get too long-winded on this question, I think gold makes a really good diversifier for a portfolio as a small percentage, but I certainly wouldn't be betting the farm on having more than any more than 5% of my portfolio, again, in any one particular asset class. Of course. Great questions.
Yeah. Thank you all so much for the engagement here. It's great. Just thank you to all the Hub folks again for the participation throughout the series.
Yes, just want to say thank you to everyone for joining us, everyone from the AIM side as well as Hub. We look forward to partnering again with Hub in the future. This has been a really successful partnership. We just appreciate everything you've done, Matt, for us, and Jesse. Looking forward to partnering again. So look out for something else coming up, hopefully, end of summer, early fall.
Yep, look out for those in-person events, people. Get to know each other a little bit.
Yes, absolutely. All right. Thanks, guys.
Thank you, everyone.
Thank you, everybody.
Matt, have a good one.
Bye-bye.